Okay. The extension of receivables management is factoring. So we have already seen in one of the slide that collection mechanism, under the collection mechanism, under where we have studied logbox, centralization, decentralization, centralized banking. So under that, we have also seen a topic called as factoring. I said I'll explain you later. So this is what it is. The factoring is just a continuation of receivables management. It is derived from the word fazer, Latin word, which means make or do or to get things done. Okay, where a company or a firm, whenever they issue products or whenever they make sales on credit basis, like it has to be collected only after 90 days or 60 days, whatever, depending upon the credit policy of the company. It will be collected only after few days. So, this happens to be a very tedious process for the company to appoint somebody to monitor the receivables, because aging factor has to be done, and in terms of days, the overdue accounts are to be maintained. So many times it becomes a tedious process for the company to make this collection by themselves. So what they do is they appoint a third party called as a factor, who get things done, who does the job of collection of debts. He collects the receivables from the buyers or from the debtors. So this person who collects or who works on behalf of the company in collecting the debts is called as the factor. It is a new concept which relieves the firm from the tedious task of collections, because if they have to do it by themselves, it requires so much of time to follow up, to send somebody to collect, or to maintain books of accounts. It requires so much of time, where a separate department or a wing has to function, where cost is involved in paying the salary, administrative expense, sometimes delinquency cost will be incurred, or many times delay cost will be incurred. So all these are the pinch in the hands of the company. Therefore they assign a third party called as a factor, who undertakes the responsibility of collecting the debtors or making the collection on behalf of the debtors. Okay, such person is called as a factor. Let us go on to the meaning. A financial service. This factor, what he does is called as a financial service, whereby an institution called a factor undertakes the task of realizing accounts receivable such as book debts, bills receivable, and managing sundry debts and sales register of commercial and trading firms in the capacity of an agent for a commission is known as factoring. So for him, it's enough if the company pays a commission, they do the job of collecting the receivables. Okay, so company is now relieved, they can look after some other important work, and at the same time the receivables are also collected promptly by a third party, who does it only for a small amount of commission. So factoring is a fund based financial service. It provides resources to finance receivables, besides facilitating the collection of receivables. Okay, this definition you can read later on. This is the mode of operation, which is called as modus operandi or mechanism on which the merchant banker works. So the first one, there are three parties involved here. Merchant, that is the firm which makes the credit sales; customer, who later becomes the debtor; and the factor, who is a third party. Now the merchant, the first one, if you see 1, 2, 3, 4, 5, 6, various numberings are given, various arrows are also done. The first one is merchant to customer, credit transaction, where a merchant sells the goods on credit. The second one is the merchant, customer and the merchant enter into a agreement that he will make the payment to the factor on a prescribed date. So that agreement is entered. Then the third is factoring contract, where merchant and the factor, you can just follow the numbers, the last is 3. Okay, merchant to factor, where factoring contract is entered between the merchant and the factor, stating that factor will collect the receivables on behalf of the company, which is otherwise called as a merchanteer. Okay, so once that contract is entered, now another fourth one is where the merchant hands over the invoice. The sales bill is handed over to the factor. Now it is the responsibility of the factor to collect the money after the credit period ends. Okay, handing over the invoice. And the fifth function is where factor financing, where when the factor collects the money, he hands over the the factor at the time of receiving the invoice. Factor financing many times is done where the factor himself will give 80% of the invoice money to the merchant, then he will go and collect it from the customer. Okay, or he will just enter into the agreement. Okay, no financing may be done, factor financing may be done. You will only wait for the credit period to end and then you will collect the money. Okay, this factor financing is an advanced operation where at the time of handing over the invoice itself, factor will give 80% of the invoice money to the merchant. So merchant need not wait for 90 days or 30 days. He will immediately get the cash. He can rotate it for his business, and the factor, what he will do is he'll give 80% money to the merchant, then he'll wait for the 90 days to get over, and at the end of the credit policy time, credit period, he will collect the money from the customer. Now the entire 100% is collected by him, is it not? Now what he will do is he will, already he has given 80% to the merchant, therefore only 20% is due back to the merchant. In that 20%, factor will take his commission. Okay, the commission may be 5% or 2%, or depending upon the nature of the business, it may be also 10%. He will retain his commission and return maybe 15% back to the merchant. Now the merchant is getting the balance 15% minus the factor's commission on a credit period ending date. Now he is not a loser. Factor, his own business is factoring, therefore he gets commission. Okay, like interest for giving 80% finance on a 3 months earlier date, he is now getting a commission. Okay, so this is what is called as factor financing. And the sixth point is where the customer makes the payment to the factor, factor returns the balance 15% to the merchant. Hope I am clear. Not all factoring agreement goes with fifth point. Okay, sometimes once the invoice is sold to the factor, he will just maintain the invoice with him. At the end of the credit period, he'll collect the entire 100%, deduct his commission and give the balance to the merchant. Okay, the features, as I have already said, all these features you can read it, and I'll just go to the types of factoring. There are various types of factoring. Domestic factoring, when there is a local sales within the same state, it is called as domestic sales. Then and that type of factoring is called as domestic factoring. Disclosed factoring, when the name of the factor is mentioned in the invoice, it is called as disclosed. Undisclosed factoring is where the name of the factor is not mentioned in the invoice. Discount factoring, factor discount the invoices of the seller at a pre-agreed credit limit. As I said, this 80% is released on the day on which the invoice is given. No, so that type of factoring where 80% is given in advance itself, then that is called as discount factoring. If 80% is not given, then it is a normal factoring. Okay, export factoring, when two parties are in different countries, the customer and the merchant, if they are in two different countries, then it comes under export factoring. Cross-border factoring, again the same as that of the export factoring. Here sometimes the factor may be also in a foreign country. Advance and maturity factoring, where the factor does not make any advance money. Okay, like 80% he will not pay earlier to the merchant. He will collect the money only from the customer, and only then if he pays. Maturity factoring is collection only when customer pays. He collects the money from the customer and only then he will pay the money to the merchant. Okay, with recourse and without recourse are the two important factoring types. Where with recourse is the factor has recourse to the client or seller firm in the event of the customer failing to pay. See, there are three parties, I said, no? If the customer fails to pay the money back, okay, what happens is then the factor who has come as a third party will go back to the merchant. See, this customer is not paying me. I have wrongly taken up this case, so I'm just withdrawing myself. Or I have given you 80%. Please return me back that 80%. If he says so, if the such type of agreement is entered, then it is called as with recourse. Going back to the seller firm is called as with recourse in case of default on the part of the customer. Okay, then without recourse is where the factor will not have the option of going back to the company. In case if the customer fails to pay his due amount, debt amount on a prescribed date, then the loss will be borne only by the factor. You know how this is possible? Yes, of course, this is possible. This happens only on a very rare occasions where the factor will charge a huge commission one, and the other one is where the factor will do a proper credit investigation. He will himself, other than the company doing credit investigation, factor himself will undertake a proper credit investigation. He will understand the track record of the company, the debtor. He will do a bank analysis of the debtor. If all these are satisfactory only, he will enter into this without recourse factoring. Okay, and the commission which the factor charge will also be very high in this case. So these are the important types of factoring: with recourse factoring, without recourse factoring. Okay, in India there are a lot of operational problems. You can just go through this.